Good afternoon and welcome to Preparing for Your First Plan Audit. We are Pension Assurance. I'm John Russin, and we're excited to talk to you about the 401k or the retirement plan audit. A lot of times we'll just reference 401k, but understand that to be any employee benefit plan audit. So this should be somewhat of a survival guide, how to survive the audit if you're in that situation, or if you're a service provider helping out clients. A little more information about what the auditors look at and what's involved in the audit. Quick background, you'll be hearing from myself, John Russin, and then my partner, Nathan Johnston, will be covering the second half of the webinar. Quick background on Pension Assurance. We're different than your typical CPA firm. We're a single service accounting firm, 100% focused on retirement plan audits. That's all we do here at the firm. We've got a team of about 27 people just dedicated to retirement plan audits. Gives us kind of a unique point of view and allows us to really focus in and find what the, where the areas are, where the higher risk is for the audits, kind of a little more awareness of the industry and the trends. And we also find some efficiencies by that exclusive focus. Last year we audited about 370 plans. And this year we're looking to audit, somewhere over 450 plans. That's a little background about us. And now let's talk about audits. First of all, we'll cover when a plan audit is needed. Some of you maybe just found out that you need the audit. So we, want to talk about how that happened. Some of you might have been very surprised by that news. Others maybe saw it coming. We'll also talk about selecting a plan auditor. If you're in a plan fiduciary role, one of the most important parts of being a fiduciary is doing some due diligence and hiring the right service providers for your plan. So we want to cover that as far as it relates to plan auditors. We'll talk about the documentation needed during an audit. Should give you some insight on what to prepare and what the auditors will be asking for during the audit. Service providers can definitely help out a lot with the audit. As the plan sponsors listening in, you'll know that, a lot of the retirement plan audit is administered or record kept by a third party. So they can be a big help to get you through the audit. And a lot of the required documents will come from those service providers. So it's just about understanding that and knowing how to use them to kind of make the audit a little more efficient and less impactful on you. Then we'll talk about a typical audit timeline so you can understand when these audits are due and kind of what the timeline looks like so that you can have it done well before the deadline comes. Okay, first we'll cover is how did this happen? So ERISA was enacted in 1974, and within ERISA, Title I covers the financial reporting of for our retirement plan, our benefit plan. And within that, it states that a large plan must file an audit. It must be audited by an independent qualified public accountant. So it really boils down to, well, how do we define a large plan? Generally, it's more than 100 participants is what you would consider a large plan. There is some exceptions to that rule, and the big one is the 80-120 rule. And so there might be some plan sponsors that might have been at 100, 105, 110 for the last few years and haven't needed this audit. And it's because you're relying on the 80-120 rule. And what that states is that as long as you have less than 120 participants, you can file the same way you filed in the previous year and the current year. So if you've got 95 participants, you're filing as a small plan. If you have 105, you're technically a large plan, but because of the 80-120 rule, you're allowed to file the same way you did the previous year. So, it makes sense to keep filing as a small plan and avoid the audit and the costs associated with that. Once you get over 120, then you fall out of that rule, the 80-120 rule. You can't rely on that anymore, and you are now officially a large plan. Do understand that going back down, you don't get out of the audit requirement. So if you do have a headcount reduction, or you clean out some accounts and you're able to drop that participant count number down, you will not be able to get out of the audit requirement until you go under 100. And because the 80-120 rule says you can file the same way you filed in the previous year, but you're already filing large, then, that wouldn't help you. I want to talk a little bit about participant counts, because that's one of the biggest questions we always get is, well, okay, so if a large plan is over 100 participants or over 120 participants, what does participants mean? And the way that's defined is a participant is anybody who actively participates in the retirement plan or the benefit plan. That makes sense. It's also anybody who's eligible to participate. So, occasionally we'll run across, a retirement plan that, only has 30 active participants in it, but the organization has maybe 150 employees, and, at least, 120, 130 of them are eligible to participate. So they get picked up in that count. The other kind of surprise is that anybody who's terminated their employment but left an account balance is also considered a participant. So you have to take into account anybody actively participating, anybody who is eligible to participate, and anybody who has participated in the past and left an account balance. So, a tip there would be, if you do have a lot of terminated employees that have left account balances, most plan documents will allow you to move that money out if it's under $5,000. So it's something to keep an eye on, especially if you're getting close to the audit requirement and you've got 20 terminated accounts and they're under 5,000, is you can do some cleanup on your census and get those out and maybe defer that audit a little bit longer. One thing to note too on health plans, we're going to mainly focus on the retirement side, because that is, those are typically what's audited. It's very rare that a health plan would need to be audited, but health plans don't even have to file 5500s until they hit 100. Once they go over 100, then they're required to file a Form 5500. There is no 8120 rule for a health plan, because they can't look back at a previous filing because they didn't file up until they got to 100. So something to note, if you're close to the audit, you might also be close or just hit that health plan, and that actually comes as a surprise to a lot of people as well, that they do need to file a 5500. Doesn't need to be audited almost 99.9% of the time, but you do need the 5500. So now that you know why you're in the audit situation, you need an audit, let's talk about selecting an auditor. Much like most service providers, or even more so maybe in the auditing world, service industries are going to look very different, from service provider to service provider, or auditor to auditor. A lot of companies may already have an auditor that they engage with for either tax return work or corporate auditor, and that auditor may or may not understand ERISA, the Employee Retirement Income Security Act. They may not understand 401k audits. So that's, probably the first person you're going to talk to about this, and, as part of your due diligence, you would want to understand if they do that or they don't, and to what extent they're committed to it. And, as much compliance as the retirement plan audit may be, there's also a lot of value that can be brought in keeping a 401k plan running without operational errors, and, kind of making that not blow up and it would be a big deal if you've got the right service providers around it. Retirement plans are getting more technical, definitely more regulated. There's a lot of scrutiny on the retirement plan. I'll talk a little bit about a study that came out that really kind of heightened everybody's awareness to the issue. And that's caused a lot of CPA firms to not even want to perform these audits, because they are very technical, very niche, and and very scrutinized. Department of Labor. So the interesting thing about 401k or retirement plan audits is that it's very public. You think about most audits for private companies, nobody really sees them other than a bank or investors or whoever's requiring it. But the audits on the retirement plans, the financial statements, those actually get uploaded to the Department of Labor website and become public knowledge. So something to consider is that these financials, the Department of Labor is looking at them, but they're also making them available for the world to look at. So something to consider on that. Peer reviews are something that a CPA firm that we have to go through every 3 years. We're required to have an independent, basically an audit. We have an independent firm come in and look at our work papers, review them, make sure we're complying with the standards. And those peer reviewers have been tasked to look at any benefit plan audits or, select a benefit plan audit if that firm is performing that, and, really kind of beat those up a little bit. So, just some additional pressure on the 401k audit space. So that study that I referenced, Department of Labor, every, say, 8 or so years, does this study, and they want to look at the quality of the auditors, or the audit work papers. And so they'll go in and do a sample. And this last one that they released, well, they did the study in 2014, I think released it in 2015. They found a 39% deficiency rate. And you can kind of track their studies over the last couple decades. And, they've always had a good percentage come back deficient, but this last one was the most. And so that kind of really made it an issue within our industry is, what kind of work are the auditors doing out there for these retirement plans? Is it complying? Is it accomplishing what ERISA Title I wanted to, which was to, have an independent set of eyes look at these 401k plans and make sure they're operating correctly and, correct reporting. And so the Department of Labor felt like at 39% deficiency rate, it wasn't. And so, they've started some initiatives and things they're doing to, putting pressure on the auditors, in some cases, maybe threatening plan sponsors to do more due diligence about their auditor selection, things like that. So we'll look at the specifics of the study. And this will probably be the only time you hear this in your life, but quantity is actually quality when it came to the DOL study. That's what they determined. They kind of ran some different statistics to see, what was the main cause of these audit deficiencies. They couldn't find a lot of correlation with peer reviews and other things, but the biggest correlation they found is the number of plans audited. If you step back and think about a service model, yeah, it makes sense if somebody's not performing, at least a certain number of plan audits, they're probably not going to be that knowledgeable about it. So in the study, you can see that basically any firm that was auditing less than 25 plans really had a very high deficiency rate. You're looking at almost 70% deficiency. Those aren't good odds when you're looking for, financial statements that are, performed by a qualified public accountant that you can submit with your 5500 and not really have to worry about it. And then even between 25 and 100, you can still see a 41% deficiency rate, not very good. Over 100 is where, they started kind of getting in that somewhat acceptable rate, although 12%, a B plus, I guess, if you're looking at it that way. That was kind of the threshold of, okay, that's the size practice that seems to understand what's involved in these retirement plan audits and understand, where the risks are and how to perform a quality audit. So what does it mean? Why do we really care? Sometimes 401k plans are considered a commodity, or they're considered, it's just compliance, just get it done. We just need financials to submit with our 5500. But it's not really the case. The case is that there is a purpose, and that, yes, it is compliance driven, but there, quality audits need to be performed and issues need to be flushed out, and, everything's self-correctable. There's, it's all about just arriving to a, well-run 401k plan that prepares its participants for retirement. And that's the end goal. But the Department of Labor does have plenty of tools to make sure that these are happening. And we've seen cases where they would actually reject a Form 5500, where they'll look at the financial statements, and they're getting better now running their, looking for anomalies when they're running this data through their, different algorithms, now that it's all electronic, online, uploaded. And, they're looking this over, they're looking at the financials, they can tell if they're not quite up to date, they're selecting work papers to review. They'll look at auditors' work papers to see what steps they performed to ensure that a quality audit was done and the financial statements are correctly stated. And so that's kind of one of their weapons, is they can reject a 5500 filing. And like I said, we've seen it. We had to come in where a 5500 was rejected. They were served a 45-day notice that basically gave them 45 days to find a new auditor, perform the audit, submit a, audited financial statements amended to their 5500, or else, they're able to threaten pretty excessive penalties. And in that case, they wanted to look at our work papers too at the end of it to make sure that, the plan sponsor did find a qualified public accountant. So that's the study. That's kind of what we learned from the study. So it gives us an overview of the auditor market. Very important to talk to a couple audit firms, do your due diligence, make sure they've got experience and committed to the space. And by doing that, you're not going to have to worry about shouldn't have to worry about a Form 5500 rejection or popping up on any Department of Labor, any of their searches or red flags. Last piece, so as I was saying, always a good practice as a fiduciary to do some due diligence. There is a request for proposal process that we encourage, and we have a template. If anybody ever wants that, feel free to reach out to us after this. But it just asks some of the important questions, and I've seen these in all shapes and sizes, and I've even got an RFP that asked me 3 questions: contact information, name, contact information, and how much. And so that's probably not a lot of due diligence. I don't think, and that is something the Department of Labor is looking at. If it is a deficient filing, they have said they could and will look into the selection process. So always good to put in some really qualitative questions that will tell you what's the CPA's commitment to benefit plan audits. Are they doing training, and is it a significant part of their practice? Is it getting staffed with people that have the technical knowledge to perform these? So some questions like that would definitely help you make a good decision, and be able to document that decision, which is one of the more important parts. Is if anybody was to come and question your fiduciary role, if you're the plan sponsor, is you can document and show that documentation that that you did do some due diligence and selected a good auditor for the plan audit. Next, I'm going to turn it over to Nathan. He will be walking us through what the audit looks like and kind of more data, more information about the audit.
Hello, everyone. This is Nathan. As John mentioned, I'm going to be getting a little bit into the details of the audit, what's involved, what kind of documents you can expect to be providing, the kind of things that we're looking at and why we're looking at them. And as well, at the end of that section, I will be getting into almost the slide that I think most people are most interested in, is what are the common things that you find? I know that there are probably people who are expecting to have their first audit this year. There are usually a few people on the call that are expecting to have their first audit maybe in a coming year, maybe next year or the year after. So that's always a nice slide to have in your pocket, because if you don't have to have the audit until next year, you've got a year to try to clean things up before people come to look at it. But anyway, let me just start with kind of the scope of the audit. One thing to keep in mind is that this is a financial statement audit that involves us looking at a lot of transactions and the compliance of those transactions with the applicable laws. But you may have even heard this terminology, limited scope audit. And I would say that most of the 401k plans out there, most of the 403b plans that are not SEC filers are filing under this limited scope exemption. The idea here is that most of your plans are with large financial institutions like Fidelity or Principal or whoever. These are qualified banks, trust companies, or state-regulated insurance companies, and so as a result, the DOL says, hey, you're looking at an institution that's already heavily regulated. We're not going to worry about the valuations that they give you. So the mutual funds, the value that they say that they're at the end of the year, or the dividends and the income that they've paid out during the year, those things, as long as we get a certification from that institution, we as the auditors can limit our scope to not look at those types of transactions. Instead, the audit really is focused on what is really the more risky area, which is all of the participant transactions that occur. That's going to be the contributions, the deferral elections that they're making, the distributions that they're requesting, whether they've been properly vested, the actual data related to participants that's in the plan record keeping. Anything else that doesn't pertain directly to the investments and the valuation of the investments is still in scope for the audit. The two implications of that is one, we can really focus on what are the higher risk parts of the audit, and two, it helps us keep fees down. It's much more expensive to do a full scope audit. Going on to the next slide here, one thing to keep in mind is that when you're doing this audit, you're not the only person that is going to be really responding to the auditor or providing documentation. In fact, most plans have a variety of service providers that are also involved in helping respond to audit requests and producing the documentation used in the audit. One might be your financial advisor, and in particular, if your financial advisor is involved in helping you manage the fiduciary responsibilities of your plan, they might be coming to your committee meetings and keeping meeting minutes, helping keep your plan documents together and updated. And so if you have an advisor like that in the picture, then a lot of times we can get those kinds of items from them directly. TPA is a third-party administrator. This could be someone separate from the person that's actually holding your assets in sort of an unbundled, what we call an unbundled situation, or you could have most of your plan administration going on with the same person that's the record keeper. In either case, typically they will have copies of the plan documents. They may have certain schedules that they're preparing. They're probably preparing your Form 5500 and probably helping you do the compliance testing at the end of the year. So there's a variety of things that we can get from them, a variety of questions that a lot of times we can go to them with if there are problems with the documents we're looking at or things that we don't understand. The record keeper is going to be someone that's providing us with a substantial amount of the audit documentation, and we'll see that in a moment when we look at the specific audit requests. But the record keeper is basically this is kind of an industry terminology. Sometimes when you hear record keeper, if you're the human resources manager or maybe the payroll person, you might be thinking, I'm the record keeper. I have all the records in my office. This is really a third party that's doing, keeping track of the participant accounts, keeping track of what their balances are, what their date of hire, date of termination, all of that sort of centralized. And a lot of those reports are what we use as auditors to pull out, to make our selections, and to look at the transactions that happen during the year. Most record keepers these days have online systems that we typically, anytime we can, we will get access to directly, which usually requires you to give us some authorization up front. But once we have that, then a lot of these records, things that we call the audit package, as well as some of the sample requests, we can go online and pull those things directly, which reduces the amount of impact of the audit on your time, which is always our goal. We're really trying to use your third-party service providers as much as we can, because you also, have the rest of your job to do that's outside of just the 401k. The plan sponsor, that's you. There's a few things that we require of you, not much. We'll look at a couple of them in a moment. There will be a short list once we do our sampling. if you think about the risk areas of these audits, it really requires us to look in a couple of specific areas. One is a lot of looking into the payroll, because everything that gets up into the plan as far as contributions starts with payroll. So we'll be looking at some of the issues that come up with payroll when we look at the common findings. But the idea is that calculations of contributions goes through the wages calculations, and so we'll be looking at those, as well as a handful of things from the personnel files, just to tie out demographic data. Here's a standard list of our required documents. I'm not going to go through these. I'm just going to cover a few general ideas. The first is just that, there's a handful of things that are what we kind of call permanent documents. They're plan-related documents that don't change from year to year, and or they don't often change anyway. And that's going to be like your plan document. There may be amendments that you've made since your last restatement of the plan document. The IRS typically issues a letter that gives you some sort of comfort around the tax qualification of the plan. So we want to take a look at that. And some of these items that you're giving to the participants, like the summary plan description, these things may change periodically, but often year over year, they're going to be the same thing. So we kind of call them permanent file documents. Then there's a handful of things that pertain to the given audit period that we're looking at. Those might be the compliance testing that you do probably around this time of year, hopefully even last month or the month before, you're working on doing the compliance testing, filling out censuses and things like that. There's a schedule of deposits, which we'll look at on the next slide, which actually we can go there now. Actually, back up for one. There's also, we'll look at the deposit schedule in a moment. There's also this handful of documents mostly comes from your record keeper. And so there's a big chunk of this checklist that we will just get by getting online access and going on and pulling down these actual statements. In the past, you might have to pull these things together for us. You might have to, have them mail us things, or even be preparing some of these schedules. Luckily, over the years, we've been able to minimize that impact. On the next slide, we have the sample deposit schedule. And this is really about the most work that you have to do for us. And, the feedback I get is it usually takes about an hour to do this schedule. It's basically just a list of the contributions that you have made during the year by pay date, and sort of their breakdown by category. If you have an employer match, we'll want to see those kind of separately broken out from the deferrals. If you have a plan that allows loans, then we'll want to see the loan repayments. This schedule, even though it takes a little bit of preparation on your side, we found that it really makes our audit work much more efficient and much lower impact. We have to ask fewer follow-up questions and things like that because we can use this schedule to kind of leverage our test work. So let's get into the fun part, common audit findings. And as I said, some of these things really do have to do with payroll. Number one really is the number one most common thing that we'll see is late contributions or inconsistent contributions. The idea here is that once you have paid your employees, you've also withheld a certain amount of money from their check that is supposed to go to the plan. If there's too large of a gap between the pay date and the date the money gets into the plan, ERISA basically views that as the plan sponsor borrowing money from the plan participants, which is a prohibited transaction, and they get really upset about it. So, if you're a small plan, as many of you probably have been, there's a 7-day safe harbor. As long as you got it in within 7 days, then it's deemed to be timely. That no longer exists as a large plan. And so as a large plan, it really is, you're really required to get that money into the plan as soon as administratively feasible. And the way that the Department of Labor investigators look at this is they will basically look at your remittance pattern. They'll see how many days do you usually get these contributions, and at. And if it's 3 days, then they might look at everything that's beyond 3 days and say that's a late contribution. If you have a late contribution, there's a couple of implications to that. One is you'll have to disclose it on the Form 5500. So there's an actual separate schedule that goes attached to the financial statements, a schedule of delinquent participant contributions, and there's a line on the compliance questionnaire in Schedule H that requires you to disclose the amount of contributions that were late for the year. So it's definitely something you want to get dialed in. In terms of your internal controls, in terms of your processes, the idea that you want to go for is just, let's set a specific process and a specific time period that we're going to get these contributions in. For instance, some of my clients, they might have payroll on Wednesday, and they might require that by the next Monday, they've submitted all the documentation to get the contributions funded. Or maybe they have a Friday and they give themselves until the next Wednesday to do it. I've got also a number of plans that do it on the pay date. And so actually the pay date and the remittance date are usually the same or within one business day of each other. You have to do something that is achievable for you, but also, you want to have something that is fairly timely, usually just a few business days, and something that you can commit to being consistent about. Another thing to think about this is, some of your organizations may be smaller, and so you may want to make sure that you have appropriate backups in place. Say if your payroll person that typically does the upload to get the contributions funded is out sick, you want to make sure that there's someone that's cross-trained to be able to do that duty so that you can get those contributions in timely. This is a big deal because when your 5500 has a disclosure on line 4A, which is where this amount would get disclosed if you have late contributions, it really does put you on the Department of Labor's radar. The Department of Labor doesn't really have a random audit selection. They don't draw your name out of a hat typically. Typically, they are looking and they're cherry picking. And I've heard it on the word of former DOL investigators that one thing they will do is they'll look at the late contributions and they will look for plans that are reporting late contributions, and they may start picking those. And their general notion is that if they're getting their contributions in late, then there may be some other things going on for us to find. So my best advice is stay off the DOL's radar, and one of the best ways you can do that is getting contributions timely. Second one here is not following the plan document. So one thing I recommend, almost the number one thing I could recommend, other than make sure you're getting your contributions in on time, is if you are working directly with your plan and you haven't read your plan document, you should do that like tomorrow. Really, the plan document dictates how a lot of different things are handled. And even though there might be multiple reasonable ways to handle them, the plan document really prescribes exactly what the specific rules are for you. And so there's certain general rules that just have to do with ERISA, which like the late contributions, but there are other rules that are set by your plan. One of these, a big one, is the definition of plan compensation. Whether or not you're going to include or exclude bonuses for contributions is something that you should definitely know. This is one of the other very common errors we'll find when we have a plan that's being audited for the first time, is we'll find errors in the definition of plan compensation. And what this is really about is understanding what does the plan say I should be using to calculate contributions, and what is happening in actual life in my payroll. And if those two are not in line, you have what's known as an operational error. And you want to either look at amending your plan to follow what you're doing in operations, or fixing your payroll system to follow the plan's definition of compensation. Another one is eligibility. Another one is vesting. Just making sure that you're following these process. The whole idea here is that your plan is, its tax qualification is premised on the design of the plan. That letter that I mentioned that you get from the IRS, that letter is based on a design of the plan that you have submitted or your plan designer has submitted to the IRS. And so the idea is that you don't have coverage by that letter if you're not actually following the design of the plan. You're operating as a different type of plan, and then you kind of start losing your premise of tax qualification. So that's why it's important to follow the plan document. A third thing is a big deal, not following a participant's instructions. If a participant makes an election, you just want to make sure you're timely changing that. Say they change from 4% to 6% or from 6% to 0%. You want to make sure that you're timely following that election and following those instructions. There's another one here related to this, which is not having documentation of the participant's instructions. So you want to make sure that somewhere, somehow, if you made a change to a participant, say deferral percentage, that you have some documentation, whether it's with your third-party service provider or whether it's in a human resources file. You want to make sure that you can substantiate why that change was made and that it happened at the direction of the participant. Sometimes, we get a little informal about things, and someone walks into your office and says, "Hey, I want to change my deferral percentage," and you can go into the system and change it, but you might not have actually gotten documentation that that authorization happened. That may not be a big deal from the participant's perspective, but it can cause you trouble when you do the audit because we're going to be asking for that kind of documentation. Final thing I'm going to say here is if you have any sort of auto-enrollment type feature, whether it's a non-elective contribution like a profit sharing where people just get a contribution based on a percentage of compensation and they don't have to make an election, they don't have to make a deferral to get that contribution, or if you have auto-enrollment where after 90 days people go in at 3% or something like that, you really want to make sure, those are great features because they definitely help participants with retirement, but they can also create a risk area for you as the plan sponsor. You want to make sure you have a good process around making sure you didn't miss anybody for auto-enrollment. If someone doesn't want to be auto-enrolled, same thing as I mentioned before, you want to make sure that you've got documentation to show that they opted out. If your standard is people are going in at 4% and they don't want to be auto-enrolled, make sure that you've got some sort of positive statement from them or document that shows that they wanted 0% and they opted out of the auto-enroll. Here real quick on the audit timeline is basically, this is kind of our standard process, but just gives you an idea of the broad strokes. The first thing we really have to do is get a handle on that audit package because that's really where all of our sample selections are going to come out of. That's where we're going to come up with, a lot of the initial questions we're going to have for you on the plan are going to come from the details that are in that audit package. So really the first part of the audit is just gathering documents and kind of getting our arms around what's the plan design, what's going on. We will prepare a set of selections, and typically we'll schedule a date for field work with you. That's typically going to be a single day at your office. More and more, we're able to do these things virtually. I've gone out to clients' offices, and it's always nice to see you guys. But sometimes it's nice for us not to be taking up your conference room for a half day when you're already sending us everything electronic anyway. So more and more clients are wanting to do these audits virtually, but in any case, it's a finite amount of sampling that we're doing, and we try to keep it sort of condensed and predictable and manageable for you. Second week is, we start building our work papers, we start drafting the financial statements. We do certain analytical procedures to try to identify issues that we think we need to look into further. And then, through the middle of the audit, we're kind of doing some wrap up. So there might be some feedback with you as we kind of do some follow-up questions. But we really try to move by week 4 into like closing out our open items, and then we have to go through our own internal review. The final steps are really, our main deliverable to you is a financial statement with our audit report. And so that starts with a draft of that document to you. So we'll send that draft to you as we're wrapping up our review of our work papers. There's a lot of documentation just to substantiate an audit these days, just to make sure we're compliant with the standards. There's a lot of internal things we have to make sure are done in our files. Meanwhile, you review that draft, let us know if you have questions on the financial statements. And once everyone's happy, there's a representation letter you send to us, and then we send you the final report for your filing. And that's really just the overall process. The one thing that you'll notice is different once you become a large plan is that you used to be able to just go submit your 5500 as soon as you were ready and had it prepared, sign off and submit. Now you kind of have a draft of the 5500 sitting out there, but you'll be waiting to finish up this audit, which has to be attached to the 5500 before you can actually submit that filing. And so you'll need that financial statement with our signed audit report to attach to the filing, and then you can finally submit the filing. So that's the general audit process, some of the things we'll look at, some of the issues that come up. Here in the last couple minutes, looks like we'll finish a couple minutes early. I'll just mention a couple things about pension assurance. And, John had mentioned the things that you're looking at for the audit quality study. If you do a deep dive on that study, there's a handful of things that really correlate with audit quality. And this is the kind of thing you should be looking at in a firm that's going to audit your plan. One is if they audit more than 100 plans annually. We're expecting we're going to audit over 400 plans this year. Greater than 10% firm revenue from plan audits. That's kind of a big deal, because if it's a substantial revenue stream, then it's important to participants, or to the it's important to the owners of the firm to make sure that they're doing a good job on that practice area. And another thing is just what kind of employee benefit plan education are the auditors getting? And ERISA there's fairly small requirements, minimum requirements, but really we try to spend almost all of our time. I think we might have a question. Yes, there will be a recording available. The question was, will there be a recording available? And yes, we will send out the link to that after the webinar. I think that's about all we have. Certainly, we would love to send you a proposal if you need an audit this year. You should be looking, obviously, at more than one firm, but we are here. And if you have general questions, even if you don't need an audit this year, consider us a resource to help you out. But thank you for attending today, and we will send out the link in a bit.